As of right now, regular market trading is closed following the August 3, 2026 session where NVIDIA stock closed at $206.64 per share, marking a strong gain of 5.67% on elevated trading volume. In extended hours and early pre-market activity on August 4, 2026, shares traded around $208.35, up roughly 6.55% from recent lows as buyers pushed price action toward the upper end of its recent range. Everyone on financial news networks thinks they understand what is driving this upward momentum, expecting another predictable cycle of data center hardware spending. But the reality under the surface reveals something far more interesting: a structural shift in how enterprise capital is being deployed across high-performance computing systems and custom physical infrastructure. While retail investors browsing popular investing sites look at headline figures, institutional traders are tracking the divergence between chip supply allocation and actual hyperscale software deployment. When you open your favorite trading app like the Robinhood app or check your individual brokerage, the consensus view seems simple. Most retail investors using Robinhood stock trading or reviewing their Robinhood investments view NVIDIA stock as an unstoppable force that moves in lockstep with tech sentiment alongside Tesla stock and Apple stock. The widespread expectation assumes that as long as major technology companies keep buying hardware, share prices must move higher without interruption. However, when you analyze trading volume metrics on Interactive Brokers or examine institutional order flow through the Interactive Brokers platform, the reality is much more subtle. Large asset managers on platforms like Fidelity Wealth Management and Fidelity Investments are not simply buying blindly. Instead, they are actively managing short-term valuation risks while accumulating core positions through targeted vehicles like Fidelity ETFs and Fidelity mutual funds. Look closely at recent daily price swings and order book dynamics to see how this plays out in real time. Over the last several trading sessions, daily price volatility has expanded noticeably, with intraday spreads stretching between $196 and over $208 per share. That degree of intraday fluctuation indicates that buyers and sellers are engaged in a serious contest over key support and resistance zones. If you pull up your Fidelity trading platform or monitor market depth on the Robinhood mobile interface, you can see that institutional volume spikes frequently occur right near the market open, pointing to heavy block trading by major institutions. Meanwhile, traders exploring Robinhood Crypto or holding cash in Robinhood cash management accounts often react to late-day momentum swings, highlighting a clear contrast between short-term retail trading and long-term institutional accumulation. To evaluate where the stock is truly headed, we must look past the superficial headlines found on generic investing sites. The popular narrative suggests that enterprise buyers are spending without constraint. The reality is that major cloud providers are becoming much more selective about their capital efficiency and projected return on investment. This distinction is critical for anyone managing their own investments through self-investing strategies or utilizing an automated service like Schwab Intelligent Portfolios. While individual investors using Robinhood fractional shares or basic apps celebrate every positive trading session, institutional risk managers using Interactive Brokers fees calculators and broad Fidelity brokerage tools are analyzing whether supply chain lead times might moderate growth rates in upcoming quarters. Let us pause for a quick moment right here. Comment below how many shares of NVIDIA stock you currently hold in your portfolio, and let me know if you are actively adding at current price levels or holding out for a temporary pullback. Sharing your thoughts helps everyone gauge how active retail market participation compares with broader market trends. Now, let us examine the core business model that built this enterprise, moving past short-term market fluctuations. At its foundation, the company operates an integrated technology system combining custom hardware architectures with specialized developer software. They do not merely supply graphics chips, they create complete accelerated computing setups paired with proprietary programming tools like CUDA, creating significant transition hurdles for corporate clients considering alternative vendors. Years ago, the business was primarily recognized for high-performance graphics cards used by PC gamers. Over time, leadership realized that parallel processing algorithms were uniquely effective for complex mathematical calculations, shifting primary focus toward enterprise data centers, automated manufacturing systems, and advanced software tools. That long-term strategic shift produced substantial free cash flow, turning a specialized hardware provider into one of the most valuable corporations worldwide. Reviewing historical financial results and past quarterly reports offers essential perspective for evaluating today's valuation. In previous market cycles, Wall Street frequently underestimated how quickly corporate buyers would adopt accelerated compute clusters, leading to impressive financial beats that caught short sellers off guard. Investors using structured online investment strategies, whether through SoFi Invest, SoFi Robo-Advisor accounts, Fidelity IRAs, or direct online investing setups, experienced substantial capital growth as data center revenues rapidly surpassed traditional gaming segments. However, historical data also demonstrates that the stock has experienced notable pullbacks whenever customer inventory levels normalized or enterprise procurement cycles paused. Recognizing these historic patterns provides valuable perspective for anyone seeking investment help or balancing long-term asset allocation. Looking ahead to the future outlook, we find a scenario shaped by distinct catalysts and noticeable risk factors. The expectation held by many retail users on the SoFi Active Investing platform, SoFi Investing accounts, or interactive brokers' account dashboards is that revenue expansion will continue in a straight line without interruption. The reality is that future performance will depend heavily on software licensing growth, custom silicon adoption, and expanding industrial automation projects across global markets. Key catalysts include deeper enterprise software integrations, expanded partnerships across autonomous machinery networks, and next-generation compute platforms tailored for specialized corporate workloads. On the risk side, global trade policies, component supply constraints, and potential corporate spending pauses present real operational challenges, reminding investors that even dominant industry leaders face macroeconomic pressures. When weighing potential future paths, investors managing SoFi stocks, tracking SoFi ETFs, or using interactive brokers' stock trading interfaces must compare current valuation multiples against operational execution metrics. If corporate infrastructure spending remains robust and enterprise software revenue accelerates as planned, fundamental reality could continue to exceed market expectations, providing structural support for higher valuation levels. On the contrary, if major customers slow down ordering patterns to integrate recently purchased hardware, the stock could enter a period of price consolidation, testing the patience of traders who expected continuous short-term upside. This structural dynamic highlights why systematic risk management is vital, whether you prefer to invest online using an individual brokerage, construct long-term allocations using an intelligent portfolio, or trade actively using interactive brokers' trading services. In summary, the narrative surrounding this technology leader is driven by the constant tension between market expectations and operational reality. While popular commentary frequently views the stock through the lens of simple momentum, thorough examination of trading volume, institutional positioning, and corporate capital trends reveals a far more balanced picture. By separating short-term sentiment from underlying fundamentals, investors can make clearer, more grounded decisions. Whether you monitor market trends on the SoFi Active Investing platform, trade across an individual brokerage, or manage wealth through Fidelity Wealth Management, maintaining a sharp focus on actual operational metrics remains the most effective approach to long-term market success. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.